Hi, welcome back to EPK Capital's YouTube channel. On this channel, we talk everything from the world of wealth, finance, and investment. In this video, we are going to be talking about how to value a share or a stock of a company. But before we begin, let me make this very clear and sort of a disclaimer that this is not an investment advisory. For any kind of investment advisory, you should always consult to your financial advisor or some investment organizations. And this video is for educational purpose only. So without wasting any more time, let's get right into it. Valuing a share of a company can be done through various methods, and the choice of method often depends on the context and available information. So here are some of the common approaches that investment advisor or you can as an investor take. Also remember that usually it is not just one of this approach, but multiple approach in conjunction with each other are taken into consideration for valuing a stock and before deciding to invest in any of the stock that you might like. Number 1. Market capitalization or market cap. This is the most straightforward method and involves multiplying the current stock price by the total number of outstanding shares. So market cap or market capitalization is equal to stock price into total outstanding shares. So this gives you an idea about what is the total market cap of a company. Earning per share or EPS. You can value a share based on the company's earnings. So divide the company's net income by the total number of outstanding shares. So that would give you a formula of EPS is equal to net income divided by total outstanding shares. Price to earning or PE ratio. This compares the stock's current price to its earning per share. A higher PE ratio typically suggests that investor expects higher future growth. PE ratio is equal to stock price divided by earning per share, as we looked at in the previous way of valuing a stock. Price to book or PB ratio. This compares the stock's market price to its book value. So that is total assets minus total liabilities. So you can calculate this by PB ratio is equal to stock price divided by total asset minus total liabilities. So the next one would be discounted cash flow or DCF analysis. So what this method does is this method estimates the present value of future cash flows generated by the company. It is more complex but comprehensive approach that considers projected cash flows, discount rate, and the growth rate. Comparative analysis. So in this you compare the company's financial ratios such as PE, PB and dividend yield to those of similar companies in the same industry to determine if the stock is overvalued or undervalued. This could also give you an idea about the entire industry, whether the industry trend is going upwards or the industry trend is also going downwards, and whether the industry itself is overvalued or undervalued. Asset-based valuation. So this estimates the value of company's assets and subtract its liabilities to arrive at the net asset value or NAV per share. Then you can look at what is the current stock price, and you can compare whether you are paying more for this stock or you are paying less for this stock, or you can get into the details of why the stock is expensive or why the stock is cheap. Dividend discount model or DDM. So if the company pays dividends, you can value the share based on the expected future dividends. A DDM calculates the present value of these expected dividends, and based on that you can decide or you can understand how much of a return this stock could give you. Industry specific methods. Now some industries have unique valuation methods, such as if you look at the telecom industries, price per subscriber for telecom companies or price per user for tech companies could be very interesting way of looking at valuing a stock. Now it is very essential to note that valuing a share is not an exact science and different methods can yield different results. Additionally, market sentiment, economic conditions, and company specific factors can influence a share's value. It's often a good practice to use multiple valuation methods and consider qualitative factors when making an investment decision. Now, moreover, seeking advice from financial professionals or conducting thorough research is advisable before making any investment choices. With that said, I'll conclude today's video, and I hope you liked the video and I hope you found the information that I provided useful. If you find the information that we have provided useful, then please share it with the people who might be interested or who might be benefited out of this as well. And if you are looking for any kind of investment advice or if you are looking to manage your wealth, you can always get in touch with us. The information will be provided in the description below, and I will see you in the next video. Till then, take care. Bye bye.